There's a disturbing trend that's quietly threatening to undermine the bedrock of our society. Karl Marx used to fret that we'd become slaves to capitalism. Today, we're turning our back on capitalism and becoming slaves to debt. Were you around in the 1980s when Maggie Thatcher was popularising the idea of owning shares and asking us all to tell Sid? British Gas, British Telecom and others made millions of Britons into mini business owners. There's over 100 years of evidence to suggest that owning equity in companies is one of the surest ways to build long-term wealth. There are very few areas where real returns consistently beat inflation. Forestry has been one of them, and I know many of you have followed me into that asset class in the last few years. You're probably expecting me to include property in this list, but in reality it depends on what time frame you're thinking about. We have a couple of generations who've grown up in a period of massive growth in residential property prices, but go back to my grandparents' generation and property was flat for decades. That's why I now prefer commercial property, such as dementia care homes, because their value is based on their yield. As care fees escalate, so should the value of the suites in which that care is delivered. But there's no doubt that share ownership should be a core part of every sophisticated investor's portfolio. So why are people moving away from share ownership? And why are companies issuing fewer and fewer shares into the world stock markets? Short-term uncertainty in the UK has led to much reduced equity investments in the first quarter of this year. While ISA campaigns have gone overboard, Artemis, for example, took every single poster on Richmond Station as part of their campaign, the actual funds being invested are hundreds of millions below what was achieved last year. At the same time, companies are buying back their own shares as an easy way of raising the share price and triggering those boardroom bonuses. But the buybacks are being funded with debt from corporate bonds, partly because interest payments on debt can be offset against profits for corporation tax. In the last 12 months, American companies have spent almost double the amount on buybacks as they have on issuing new shares to the market. There's also a driver for this from the increasingly technology-centric nature of many companies. If you only need to develop some cool software or the must-have iPhone app, you don't need factories, you don't need plant and machinery, you don't need hundreds of staff. What you almost certainly have is access to oodles of private capital hungry to invest in the next big thing. They then ride the wave of growth as the product takes off and only come to public markets to achieve a multi-million or even billion-dollar exit when the main growth has happened. It's also much easier to manage a privately owned company, far less compliance and regulation to worry about, no quarterly reports to the financial press or shareholders to disrupt your longer-term strategic thinking. So the upshot of all this is that Sid will find it harder and harder to get into the equity market and experience the inflation-busting growth that he needs to plan for his golden years. More worryingly, it fuels the increasing disconnect between ordinary folks and the business world. As politicians and knucklehead champagne socialists like Russell Brand demonize business at every turn, we need the counterweight of a sizable minority of the population to acquire shares and experience the benefits of owning a piece of the pie. If you think we can have a stable investment climate when fewer people than ever are engaged in capitalism at the most basic level, be very careful out there. 96% mortality within the first decade of life? Welcome to the world of the entrepreneur.